In terms of rate of change on the economy, we have seen just an absolute roller coaster ride. At the end of March, the economy started to unwind, and we have seen numbers that the United States has never seen in terms of unemployment, in terms of collapse of GDP, manufacturing numbers coming down. When we shut down the economy to stop the surge in coronavirus cases, the economy was shut down alongside of it. Now, the good news is we are seeing some remarkable recovery numbers. We're not back where we were pre-corona. That may take some time. We've got a lot of water to carry in this economy to get there, but there are some promising signs, and here's a few. When we look at things like TSA traveler checkpoints, and that's people going through to get on planes, we're starting to get back to where we were in March before this thing really hit its trough. We're not where we were last year, but a major improvement from under 200,000 up to about 700 and change. MTA Transit Authority turnstile hits way up from the bottom. When we look at open table reservations, literally they were at zero, and now they're starting to come up again, and we're seeing progress. Weekly gasoline demand. This is up pretty significantly, actually, and starting to get back to where we were. In other words, people may not be flying, but they want to get out, and they're driving, and so that's positive. There's no question that to this point, we are starting to see, with all of this new data, a V-shaped bounce. Now, will the V go all the way back up to where it started? That's to be seen. But right now, we are definitely in a V-shaped bounce, and on the global economy especially. This next chart shows the Citigroup Economic Surprise Index. It measures forward-looking economic data, and as you can see, it was absolutely horrible back in March and has rallied almost all the way back up to where it was this time last year. So that's good news. By the way, China has almost fully recovered. They were first to get it, obviously. They're seeing a remarkable rebound. Europe is starting to rebound very quickly. In fact, on the next chart, these are IMF growth estimates. And the IMF is seeing significant reduction in the growth of GDP all over the world here. China, India, US, Germany, all across the world. That's the blue lines, and they're down, and they're pretty significant. But look at the orange lines. So that's the 2001 growth estimate, and as you can see, they're up pretty significantly. We're talking about growth rates up across the board in every country next year. So when we look at these IMF growth estimates, what it tells us is that what the expectation here is a massive trough and a big pent-up demand surge in GDP, followed by probably above average growth and then settling to normal growth. This next chart shows street estimates, and as we can see, they're all over the place. Nobody really quite knows how to dial this thing in yet. In the second quarter of 2020, which will prove to be one of the worst quarters in history, we see that the estimates ranged all over the place from basically 10% to 60, probably going to come in around 34. Next quarter, the estimates in third quarter range from basically negative to plus 60. The market just doesn't know what to expect. The average is about 20. Same thing for the fourth quarter. And then you see in 2021, the expectations start to come in as we get past this initial rush of the coronavirus. So what is driving this recovery? Well, obviously opening back up. And remember, the world is opening up very quickly. As a matter of fact, in Europe, some countries never actually shut down. And so as we open up, there's economic activity, there's pent-up demand, people want to get back out. But also what is important here, as we'll see on this next chart, is monetary response. Massive stimulus by the federal government, massive capital being poured in the system by the Fed, trillions of dollars in the system has helped support and buoy the economy. In fact, some interesting numbers here. The U.S. consumer is actually in wonderful shape. Their savings rate is up in the 20s. The actual income numbers have risen during this. Why? Because of all of the stimulus, because of the unemployment benefits, the extra money that was put in. And so there is money in the economy helping to prop this thing up and hold it as we get through this. Very important, a very important factor in terms of the recovery itself. Jobs have been lost. As this next chart shows, 14 million. Now, we have recovered faster than was expected, but this is an enormous pullback, which is to be expected when you shut an economy down. As you look at prior recessions here, all the way back into the 60s, we really haven't seen anything like this. So we also expect a recovery that we haven't seen, and we also are seeing stimulus that no one has ever seen, and that we suspect is one of the reasons why we're able to recover. If this was a normal recession and we lost 14 million jobs, the damage would be extraordinary had the government not come in, had the Fed not come in. So in summary for the economy, we're right at that tipping point. There are some pluses and minuses. In terms of tailwinds, we've got a lot of money in the system from the Fed. Household debt is at a record low. Net worth is at a record high. It's not like it was in 2009 when we crashed. Okay, in 2009 there was no savings, terrible balance sheets in terms of consumers. We've got a lot of fiscal stimulus, probably more coming. A lot of pent-up demand, and we have low prices. And by the way, on that pent-up demand, just think about it. The person who needed a car 6 months ago couldn't buy it. They're going into the shop today with the person who needs a car today. That's why you get these dramatic increases. Now, in terms of headwinds, there's a lot of uncertainty around the election. Is taxes going up, going down? What does that mean? We have the recovery in the labor market. That's going to take a little while. Bankruptcies are rising. What is the impact of that? The regional lockdowns, is this surge? Are we going to see wider lockdowns, a national? Is that going to come back? Something to look at. We have rising debt, obviously. We can't just put all this money out and ignore it. The debt levels are rising in the locals, the states, and the federal government. And the global recovery has to catch up to the major markets. So a lot here, a lot to digest, but overall, if we think about where we are right now in early July, and we compare that to what we expected early July to look like at the end of March, I would say people, by and large, would say pleasantly surprised.